Diversification is one of the golden rules of investing, and for good reason. It's how smart investors reduce risk and stay more stable through market ups and downs. But let's face it, trying to diversify doesn't always mean you do it right. Many investors, even experienced ones, make common mistakes that weaken their portfolio without realizing it. In this video, we will break down the top 5 diversification mistakes and, more importantly, how to avoid them. The content provided in this video is purely for informational purposes and should not be considered investment advice. Please do your own research or consult a financial advisor. Let's start with a mistake that sounds smart, but isn't. Mistake number 1. Thinking more equals better. It's easy to believe that holding 50 or even 100 assets means you're well diversified. But quantity doesn't guarantee quality. In fact, owning too many of the same type of investment can create a false sense of security. For example, if you hold 30 tech stocks, looks good at first glance. But if all react similarly to industry news, you are still exposed to the same risk. This mistake even has a name. It's called diversification. Similar assets actually increase your risk exposure and reduce your returns. Diversification isn't about collecting loads of investments. It's about building a strong mix across asset types, sectors, industries, level of risks, and maturities. So you don't just count how many investments you have. You ask yourself, how different are they from each other? Now here's a mistake that even experienced investors overlook: ignoring correlation. You might own multiple stocks or multiple cryptocurrencies and feel pretty diversified. But if they all react the same way during a market downturn, are you really protected? Correlation means how closely two investments move together. If they rise and fall at the same time, they're highly correlated, and your risk is still concentrated. Let's say you invest in several US tech stocks plus the S&P 500 ETF. It feels diversified, but they are tied to the same economy and can drop together. The goal? Own assets that behave differently. When one drops, another might stay stable or even rise. That way, when the market throws you a curveball, part of your portfolio can act as a cushion. Mintos offers investment into assets like loans, corporate bonds, and real estate that often have low correlation with traditional stock market and add the needed balance to your portfolio, especially in volatile times. So always ask, if this asset drops, how will the rest of my portfolio react? Mistake number 3 is one of the sneakiest because it happens over time: forgetting to rebalance. You might start with a well-diversified portfolio, like 60% stocks, 30% bonds, and 10% alternative assets. But over time, markets shift. Stocks might grow faster and suddenly your 60 becomes 70%. Even without noticing, your portfolio has drifted, and so has your risk. This is why rebalancing is essential. Rebalancing means checking your portfolio from time to time and adjusting it back to your target mix. That might involve selling a bit of what has grown too much and reinvesting into underweighted areas. It's not about market timing, it's about risk control. So remember, diversification works best when it stays in balance. Mistake number 4, sticking only to the usual stuff. A lot of investors build portfolios with just stocks and bonds. While these are important building blocks, they are not the full picture. Non-traditional assets like real estate, commodities, or peer-to-peer loans can add stability and potentially improve returns. Why, you ask? Because they often react differently to economic events. During a crisis, stock prices may fall, but loan repayments or rental income might continue. That's the kind of behavior you want to have in a diversified portfolio. Adding non-traditional assets is about being strategic. It means you're not depending on just one kind of growth. Mistake number 5 might be the most dangerous of all: confusing diversification with complete safety. Yes, Diversification reduces risk, but it doesn't remove it. Some investors build diversified portfolios and think they are safe. But every investment carries some level of risk, even if it's spread across multiple assets. Diversification can soften the blow, but even a well-diversified portfolio can lose value during big events like market crashes, pandemics, or global recession. The right mindset is risk awareness and not risk denial. That's why it's so important to invest based on your goals, timelines, and risk tolerance, not just how many assets you hold. So don't treat diversification like a shield. Think of it like a seatbelt. It won't stop a car crash, but it can protect you from serious damage. So let's quickly recap the 5 key mistakes to avoid. It's not about more, it's about different. Correlation matters. Rebalancing is essential. Don't skip non-traditional assets. And diversification helps, but it doesn't mean complete safety. If you found this video helpful, give it a like or tell us in the comments. Subscribe to our channel and hit the bell for more videos on investing. Thanks for watching and see you next time.